All those things can be depreciated at a faster rate and segregated into shorter asset lives, depreciated at a faster rate, which creates or front loads my depreciation. And that gives me a bigger write off in the early years. Now, there's a number of reasons why you want to do that. There's time value of money, there's inflation. I want my dollar today versus the IRS holding on to that dollar for 39 years.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is your host Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. As a real estate investor, we are always looking for ways to save taxes, and cost segregation is one of the most powerful tools that we have in our arsenal. So today our guest is Erik Oliver, who is a VP at Cost Segregation Authority, a national provider of cost segregation services. He helps a real estate investor accelerate depreciation, minimize tax liability, and optimize wealth building. So Erik, welcome to Decoding Cashflow. It's a pleasure having you on the show.
Oh, thanks, Ted. I'm glad to be here.
All right. So I just give a couple of line background about you. So if you can, give our listeners a little bit more in-depth background. How did you get started in this segment? What did you do before that? And what's your main focus as of now?
Yeah, no, that's a good question. So, like most 18, 20-year-olds, went to college, was trying to get through with college as quickly as I could. So math always came somewhat easy. I never liked writing papers, was never good at the sciences. So decided it was either going to be a finance or an accounting degree. Accounting was able to get me done a little bit quicker. There was a couple classes less than the finance degree. So I went the accounting route, never actually used my accounting degree. I ended up in a business development position, been kind of in sales for a number of years, which took me to the East Coast. I was born and raised here in Salt Lake, and then moved to Richmond, Virginia for about 12 years, Long Island, New York for about 5. And then I was looking to come back to Salt Lake. My parents were getting older. By that point, I had kids and wanted to get back to family here in Salt Lake. So I started looking for different career opportunities, came across this thing called cost segregation. To be honest with you, Ted, wasn't sure what it was. When I applied, I had to go watch the YouTube videos to figure out what exactly it was. All I knew is it had to do with accounting and some business development and real estate. And so I thought, okay, well, those are things that I'm interested in. Let's see what this cost segregation thing is all about. So interviewed for the job, got the job, came out from New York at the time, came back to Salt Lake. Been working in this industry about 8 years now. It's been great. I always had an interest in real estate, and then found cost segregation just to be a powerful tool for real estate investors. So, like I said, for the last 8 years, I've just been helping real estate investors reduce their tax liability through cost segregation and some of the other services we offer here. But that's kind of the journey to where I'm at now.
Wow. But did you have any real estate experience before you joined this group doing cost segregation?
I had 2 single-family rentals. One was an absolute disaster when I moved from Richmond, Virginia, up to New York. I decided to keep my primary home that I had purchased in Richmond, keep it as a rental while we were living in New York. Didn't want to pay a management company to do it. I thought, I can do this myself. So, what is that? 4 or 5 states away from New York, trying to manage a property in Richmond, Virginia was an absolute disaster. I learned the hard way that a management company was what I needed, at least in my investing journey, because I didn't have the time. And I was, like I said, 4 or 5 states away to try and find renters and screen renters. And I eventually had to evict some renters. And so that was my first investment property. I had one other one before I started here. And then one of the great benefits of working here is being able to go to conferences across the country and present on cost segregation. But then also while I'm there presenting, I present for an hour, and then I've got 7 hours of education that I get through these different conferences. So I've been able to make some investments into some other properties, some micro apartments, some short-term rentals since I've started here, but just had a couple properties before I started.
So, so, let's get started with like just the basic of cost segregation, right? If you can give our listeners a basic understanding, 101 kind of, uh, class of cost segregation, what exactly it is, how you use it, uh, and then we can dive deep into the other aspects like bonus depreciation, accelerated depreciation,
Sure.
recapping. We'll dive deep into that. Let's first understand what cost segregation is.
Yeah, so cost segregation really is just accelerated depreciation on your real estate assets. So,
Yeah.
one of the benefits of owning real estate is the IRS or the government, the federal government, and the state government for that matter, they allow you to depreciate your building over time. So as you own a building, it slowly deteriorates and is worth less and less. Now, property values go up, but your building itself is worth less and less in the eyes of the IRS because it's slowly deteriorating. So for residential units, anywhere where somebody lives, you get to depreciate those over 27 and a half years. Any commercial units, you get to depreciate over 39 years. So just to make the math easy, I'm here in an office building, and let's say I bought this office building for 390,000. I would take that 390,000, divide it by 39 years, and essentially I'm getting a $10,000 write-off every year for the next 39 years. Now, I've oversimplified that just a little bit because you always have to pull out the land value because land is
Mhm.
non-depreciable.
Yeah.
But if the building structure was worth 390 when I bought it, that's what I paid for it, then I would get a $10,000 write-off every year. Again, 390 divided by 39.
Yeah.
And that's what we call straight line depreciation, and that's a great benefit to have. That depreciation comes off of our taxable income. So let's say I was making 110,000 of income each year. I've got this building, and so I get a $10,000 write-off. Now, instead of being taxed on 110,000, I'm only taxed on 100,000.
Mhm.
That's again straight line depreciation. The problem with that is I may not plan on owning my building for 39 years. I want my deductions now versus spreading them out evenly and taking 1/39th of a deduction for the next 39 years. And the way that I'm able to do that is through an engineering based study where we go in and we identify different pieces of the building that the IRS says should depreciate at a faster rate. So, for example, this you can't see it here, but there's carpet here on the floor. Carpet is a 5-year asset. These window coverings behind me, those are 5-year assets. The parking lot outside these windows is a 15-year asset. The problem is we buy this building and we give our closing statement to our tax preparer, and they don't know that our building has carpet, let alone the value of that carpet. And so a cost segregation company will come in, identify all those different bits and pieces of the building, and put values to those to total up to the 390,000 purchase price. So for example, the carpet might be worth 12,000. These window coverings might be worth 8,000. We've got a $30,000 parking lot outside. All those things can be depreciated at a faster rate and segregated into shorter asset lives, depreciated at a faster rate, which creates or front loads my depreciation. And that gives me a bigger write off in the early years. Now, there's a number of reasons why you want to do that. There's time value of money, there's inflation. I want my dollar today versus the IRS holding on to that dollar for 39 years. And so,
Yeah.
number of reasons why we would want to take our deduction faster, but that's the idea is to front load or take your depreciation at a much faster rate.
And as you said, you create a tranches, right? 1 year, 2 year, 5 year tranches, and bucket these items,
Yep.
the value of these items accordingly. Now, when now talking about you said about the cost segregation, how it works. Now, to take advantage of this cost segregation, let's touch base upon the bonus depreciation clause or the legislation that IRS has right now, right? Of course, it's reducing, I think this year it's what, 60% bonus
That's it. Yep.
depreciation. So these tranches, like 2 year, 5 year, 10 year tranches that how would how would you maximize the what do you say, or how would you take advantage of these tranches in bonus depreciation? What would you count, under
So that's
this?
a great question. So So bonus depreciation has been around for a number of years. The government uses bonus depreciation to stimulate the economy. And what they do is they say, okay, if you go buy something, as long as that thing that you buy has a useful life of 20 years or less, then we're going to give you a larger deduction in the early years. So, for example, if the economy is doing well, they'll decrease the bonus depreciation. If it's not doing well, they'll increase it because they want to get people to go out and buy stuff. So let's use a bulldozer, for example. If I go out and buy a bulldozer, let's go back to 2017 because that's when the tax law changed. If in 2017, if I went and bought a bulldozer and it was a brand spanking new bulldozer, it couldn't be a used bulldozer, it had to be a new bulldozer, and I spent $1 million on it, at the time, the government was giving 50% bonus depreciation, which means on $1 million asset, I'm going to be able to write off 500,000 of that or 50% of that in year one. The other 50% or other 500,000 gets spread out over the useful life of that bulldozer. Mm-hmm. Fast forward to the end of 2017, we had some legislation come through. Donald Trump was our president at the time. Donald Trump owned real estate. And when he revised the tax code, it was very favorable to real estate investors. Two things changed. One is they went from 50% bonus to 100% bonus. Mm-hmm. And two, more importantly, they added a few words to the tax code that made all the difference in the world. Remember, prior to 17, you had to buy a brand new bulldozer. Mm-hmm. Once they changed the tax law, it said new to you, the investor, or to you, the taxpayer is what it said. Okay. So what that means is I can go buy a used bulldozer. That bulldozer is new to me, the taxpayer, and all of a sudden I'm eligible to take bonus on that. Mm-hmm. Let's talk about what this means in real estate. So remember, real estate is usually depreciated over 27 and a half or 39 years. So some tax preparers I talk to, they're like, well, bonus doesn't apply to real estate because real estate's 27 and a half or 39. And in order to take bonus, you have to have a useful life of 20 years or less. So I said, well, wait, we can make it apply to real estate because what if we do a cost seg study? We break up that 27 and a half year asset into 5, 7, and 15-year buckets. Mm-hmm. All of a sudden, we can take bonus on those 5, 7, and 15-year assets.
Anything below 20 years, right?
Anything below 20 years, yeah. So some of it stays, like the walls, the windows, the doors, that stays in that 27 and a half year category, mm-hmm. not eligible for bonus. But your carpet, your appliances, your countertops, your parking lots, all that stuff gets bonus applied to it. So bonus, when the tax law changed, I mentioned they changed bonus from 50% to 100%. Yep. So any assets placed into service between 9/27 of 17 and 12/31 of 2022 are eligible for 100% bonus. Anything that goes into service in 2023 is eligible for 80%. As you mentioned earlier, 2024 is 60%. And it drops 20% each year until 2027 when it's back down to zero. Now, in saying that, there is a bill in front of Congress. It actually just got voted down, but there was a bill in front of Congress where the House of Representatives, they passed it almost unanimously, had bipartisan support, and what they proposed was to extend the 100% bonus through 2026. It passed the House, got to the Senate, and the Senate decided, hey, wait a minute, we're in an election year, presidential election year. We don't want to pass this tax bill now because this is going to look good for the Biden administration. So what they did is they voted it down. Now, between you and I, 95% of the people in Washington, D.C. own real estate. All these politicians own real estate. They all want bonus, whether they tell you that or not. True. My hunch is after this presidential election, I believe that Congress is going to get back together. They're going to put together a comprehensive tax bill, and then they hopefully will pass that tax bill early next year before we have to file our 2024 taxes. And in that tax bill, I'm hoping that they will extend the 100% bonus through 2026. So right now, the tax law that's on the books right now says 60%. But between you and I think there's a good chance that we could see that go to 100% before we have to file our taxes next year.
Okay. And what do you think, like, for example, let's say some of the investors took 60% depreciation this year. If the bill changes to 100% next year, can you recoup or can you just do some balancing?
That's a good question. Unfortunately, because the presidential election's not till November 15th, and the end of the tax filing season for 2023 is October 15th. So my guess is those of people who bought properties in 2023 are going to be stuck using 80%. Those who bought properties in 2024, because we're not filing until next April, hopefully they pass the law and they backdate it, which allows us to take the 100%. So unfortunately, if you bought properties in 2023, I think you're stuck at the 80%. But I'm hoping that those of us who bought properties in 2024 will be eligible for 100%. But again, we'll just have to wait and see if Congress can get their act together and get something passed before we have to file.
Okay.
So what usually happens is they put these bills together. So there's all this tax software out there where all these CPAs use this software to file taxes. The tax software companies need time to implement the bonus depreciation within their software. So they would have to pass something in January or February. That would give the tax preparers, the software companies, a month or two to fix their software so that when people start filing in February, March, it's all fixed. And so that's usually when we see these tax bills get passed is early in the year because they got to allow the tax software companies time to update their software so that they can get them filed. So I'm thinking early next year.
Okay. And now, of course, these depreciations, right? Let's talk about who can take advantage of these depreciations, active versus passive investors, right? Because some of the passive investors, they might not be registered as real estate professionals. So let's talk about that. If you can give our listeners about how who can take full advantage of this.
Yeah, no, that's a great question. So when we do these cost segregation studies, Ted, usually the deductions we create are considered passive. So I'm a W-2 employee. My wife is in the school system, so she's a W-2 employee as well. So when we do a cost seg study and we create this large deduction, unfortunately, I can't use that to offset my W-2 income. I can only use it to offset passive income because I do my real estate on the side. This isn't what I do every day. I sell cost seg every day. My real estate is on the side. So because that's considered a passive activity, those deductions are considered passive and they can only be used to offset passive income. Now, there's a couple ways around that. One is if let's say my wife was fortunate enough to stay home and she managed our properties and she became a real estate professional, as you mentioned, and we file a joint tax return, then all of our cost seg deductions become active and we can use those to offset my active W-2 income. So to become a real estate professional, it's typically 750 hours a year doing real estate. It's about 14 hours a week. That's the easy test. The harder test is you have to spend 51% of your working time doing real estate. So if you're a W-2 employee somewhere and you're working 40 hours a week, you'd have to then work 41 hours a week doing real estate on top of that. And the IRS isn't going to believe that you're working 81 hours a week, and so it's hard to qualify. So if you're not a real estate professional, there's a couple other ways to get around that active versus passive. One is you can utilize the deductions in a year that you sell an asset. So in me and my wife's situation, where we're both W-2 employees, if I have a property that I sell and I have a large capital gain, I can use my cost seg study to offset that large capital gain. That's one way. So in the year of sell, you typically can use those deductions to offset the capital gain. Okay. The second way would be it's called the short-term rental loophole. I don't know if you've heard that term. A lot of folks are doing it. But if you're buying an Airbnb or a VRBO type property, oftentimes you're managing those yourself. You can then say that you're doing an active business. I actively manage my short-term rentals. Therefore, those deductions are considered active and they can be used to offset my active income. But it has to be on a short-term rental property where the average stay is less than 7 days. The reason for that is those get treated more like a hotel than they do a rental property. And so if you're investing in short-term rentals, you may be able to take advantage of that loophole as well. But otherwise, being a real estate professional gives you the kind of the golden ticket to be able to fully utilize these deductions. I will add one last thing. These deductions don't expire. So if I do create a large deduction by doing cost segregation, and let's say I create a $100,000 deduction, but I only have $10,000 of passive income, I just wipe out that $10,000. I don't pay any tax on it. And then $90,000 that's left carries forward into next year. I wipe out my 10,000 next year, keeps carrying forward. In that case, it would take me 10 years to utilize it all, but you don't ever lose those deductions. They just get carried forward.
Okay. All right. So that's good to know. The other aspect I wanted to touch base upon was, many people, they all also buy vehicles in their business. Like as you said, bulldozer. You gave an example, right?
Sure.
So yeah. So many people they'd buy business vehicles, a truck or anything for the business purpose, and they can also take advantage of this bonus depreciation and deduct the expense of buying the vehicle, right? How would 179 be different than this bonus depreciation? Like, there's other clause 179, which normally they use it for the vehicles. So
Yes, so there is a section in the tax code, section 179, which allows certain business expenses to be written off in the first year. You just get to write off the whole amount.
Okay.
So it is only for business items. So you'd have to have business items. But 179, and there are limitations on 179. So you can only write off a certain amount. But Section 179 is oftentimes used for different types of, whether it's a company vehicle, equipment, but it allows you as a business owner to write off those expenses all in the first year without having to depreciate them over a certain amount of time. And so it's a great vehicle. Like I said, if you own a business and you're buying equipment or vehicles for that business, Section 179 is a great way to be able to create expenses. And that's why you see a lot of people go out at the end of the year, they might go out and buy a new truck. And that's because they needed a truck, number one, but number two, they can also write off a portion of that truck as long as it's being used for business use.
Yeah.
So Section 179 is a great tool to do that.
All right. So now let's go on to you have to, let's say investor has taken a depreciation for like 5 years and now it's a time to sell the property, right? So you got to recapture all the depreciation. Now let's talk about this, like how would the investor get impacted by this recapture, and are there any ways to save taxes during that period while selling it?
Yeah, no, another great question. So when you sell an asset, you pay two types of tax. You pay depreciation recapture and you pay capital gains tax.
Yep.
And as you mentioned, depreciation recapture is calculated based on how much depreciation you've taken. So the more you take, the larger tax bill you're going to have when you sell this asset. Well, that's not actually true. And I'll explain why that's not. I'll kind of back into that. So let's say you buy a building for $1 million and you sell it 5 years later for $2 million. When you go settle up with the IRS, you're telling them that everything is doubled in value. I bought this office building with everything in it for $1 million. I'm selling this office building and everything in it for $2 million, so everything is doubled in value. Well, my walls have doubled in value. My land maybe has doubled in value, but certainly my dirty, nasty carpet that's stained and it's 5 years old is not worth double what I bought it for. Same thing with my appliances. Same thing with my parking lot. Those things don't go up in value. They go down in value. And if you remember, I mentioned carpet is actually a 5-year asset. So when I bought that carpet and I owned it for 5 years, when I go to sell it, the book value is actually zero. It's not worth anything according to the books. Now, it's probably worth something. It still has some useful life, but according to my books, it's a 5-year asset. I've owned it for 5 years, which means it's fully depreciated and it's worth zero. When I go sell my building, I should be selling my carpet for zero. I shouldn't be selling my carpet for double what I paid for it. The problem is if you don't do a cost seg study, you don't know the value of your carpet when you originally bought the building. You just know that everything is lumped together in this one big asset. And so by doing cost segregation, it allows you to allocate the sales price to the right bucket so that we're not saying to the IRS, hey, our carpet is worth double today than it was 5 years ago. And now you're going to charge me tax on that gain. You shouldn't be paying gain on your 5-year assets when you've owned them for 5 years. So the whole idea with recapture is take your deduction today against your ordinary income rate of, let's call it 35%, pay it back at a future date in 5 years when I sell it on a lesser amount at a lower rate. So take your deduction today at a higher rate, pay it back on a lower rate at a lesser amount, and save the spread. So we're taking advantage of some rate arbitrage where we have to pay it back at a 20% capital gains rate, but we're taking the deduction at a 35% income rate. Therefore, we're saving that 15%. So you get to keep and use all that money for those 5 years. And then when you pay it back, you're paying it back at 15% less in that example than you're getting the deduction at.
Mm-hmm. So what you're saying is you're converting the regular tax bracket of 30 to 35% into 20% capital gain tax. You're moving portion of the sale price to capital gain bucket.
Yep, exactly.
Okay.
Portion of that sales price that normally falls in that recapture bucket, you're shifting it over to capital gains at a lower tax rate and saving the spread. You got it.
Okay. All right. And it can be done on any properties, right? Residential, commercial, anything.
Yep. Any revenue generating property, anything other than your primary residence that's generating revenue that you're allowed to take depreciation on, you can do cost segregation to accelerate that depreciation.
So in a way, what you said is cost segregation can be done, of course, while you owning the property to get the depreciation year over year, and before selling the property to see how you can, take a benefit of the depreciated assets.
Nope, that's right. Yep.
Mm-hmm. Okay. So now with the cost segregation study, right? If let's say someone bought a multifamily, what's the process to get started to get the cost segregation study done? How? Yeah.
So that's to do a cost segregation study, the first thing we want to do is make sure it's a good candidate for cost seg. Mm-hmm. So at our company, we'll always do a free benefit analysis to say, okay, give us the address, tell us what you paid for it, and we're going to determine conservatively what we could do with the depreciation on that asset. So we're going to come back and say, okay, you bought it for $1 million. We think we can create a $200,000 deduction. It's going to cost you $4,000 for us to do the study. And then you give that benefit analysis to your tax preparer and say, hey, I've got this asset. I think it's going to save us some money. What are your thoughts? And then let your tax preparer look at everything else. They're going to look at whether you're active versus passive income. They're going to look at things like what other deductions you have. What is your income? Once they analyze that, they'll help make that decision on whether or not it's a good year to do the cost seg. The nice thing about cost segregation is you don't have to always do it in the year you buy the asset. You can kind of pick and choose which year you do the cost seg study based on your tax brackets. So you want to use cost segregation to manage your tax brackets down into something that's more reasonable. And so the first thing you'll do is get that benefit analysis done. If you and your tax preparer decide that it makes sense to move forward, then the second step would be for us to complete a site visit. So the IRS requires us to go do a site visit. So we're going to look at the property. We're going to look at what type of flooring. We're going to look at how big the parking lot is, look at all the appliances, put values to all those components. Once our site visit is done, usually takes us about 10 to 14 days to compile all the numbers. Once we've compiled those numbers, we're then going to issue a final report. Now, that final report is probably going to be 40 or 50 pages. Your tax preparer is going to go to the last page, which has the revised depreciation schedule. They're going to upload that into their tax software. And that's how you're going to realize the deductions. And so that's kind of the process. Usually takes about 30 to 40 days from start to finish for us to complete one of these studies.
And normally the pricing is based on the asset value, or
It's actually based on, for us, it's based on the type of asset, the square footage, and the acreage of the lot. So
okay.
we base it on how much work is going to be involved for us to complete the study. Um, you can imagine a big empty warehouse is a lot easier for us to do than maybe a strip mall where there's 9 individual tenants and we got to get into each
Yeah.
of those tenant spaces. So the type of asset, square footage, and the acreage are kind of what determines our fee.
Mhm. All right. Okay. And the other thing I wanted to mention is when we talked about the depreciation recapture, right? If you put 1031 exchange into play while you're selling it, how does it impact this cap depreciation recapture?
No, that's a great question. That's a great way to avoid the depreciation recapture altogether. So oftentimes you buy a property, do a cost seg study, and then 1031 exchange. And when you go do a 1031 exchange, you pay no recapture and no capital gain. So it will, when you've done a cost seg study and you 1031 exchange, it will impact your depreciable basis in the new property because you
Okay.
have to account for the depreciation you've taken. So you got to lower your new basis in the new property. It's called your adjusted basis, but you'll adjust your basis down to account for the depreciation you've taken. But as long as you're investing up into larger or more valuable properties, so you're selling your property for 500,000, doing a 1031 exchange and going and buying $1 million property, as long as you're exchanging up, there's always going to be new basis for you to do your cost seg studies on. So that's the key there. But yeah, that's a great investment strategy that a lot of people will do is buy a property, do a cost seg, 1031 exchange, do a cost seg, 1031 exchange, and then unfortunately, we all die, and then our estate gets a step up in basis at the time of death, and nobody ends up paying tax. And so that's an investment strategy that a lot of investors will do is the 1031 exchange, die, get the step up, and no one pays tax.
And as we discussed earlier, right, before you sell the property, you do the cost seg so you can move the regular tax, move the amount from the regular tax bucket to the capital gains bucket. So can we use the same method before doing a 1031 so that the basis get adjusted accordingly, a little bit higher basis than the existing? Is it possible?
Well, your basis will still come down. So when you do a 1030, you can do a cost seg study before you sell.
Uh-huh.
However, if you've got a property, you've owned it for 10 years, you've never done a cost seg, and you're going to 1031 exchange into the new property,
Mhm.
your benefit's going to be the same whether you do it on the old property or the new property. You're going to want to do it on the new property because it's less complicated for your tax.
Okay.
Because everything gets adjusted. So it's not like you're going to get any extra benefit if you do it earlier or later. So in that instance, we would recommend doing the cost seg study on the new property with the adjusted basis and getting the deduction that way. Because you're not going to have to adjust your basis down as much because you didn't do a cost seg on the first property. So doing cost segregation, because you're taking such a large deduction up front, it lowers your cost basis at a much faster rate.
Yeah.
And so, yeah, hopefully that answers that question.
All right, Eric, loving this conversation, but I want to be mindful of your time also. So before we move on to the final round of question, is there anything else that you would like to tell to our listeners?
I don't think so. Just please use this as a resource, you guys. We're kind of a niche accounting firm where we don't charge by the hour. If you guys have any questions on depreciation or real estate tax in general, give us a call. We don't actually do tax returns here at our firm. We just do these cost segregation studies. So if you call me and ask me about earned business income or child tax credits, I don't know anything about that stuff. I'll send you back to your tax preparer, your CPA. But if you've got questions on real estate depreciation, we can usually answer them. So please use this as a resource.
Yep, surely they will. Eric, let's move on to the final round of questions. Are you ready?
All right.
All right. So, which is the one book that you'll recommend which had a most impact on your life or on your business?
I'll pick one that's had the most impact on my business and basically what is it I do today, and that's a book by a guy named Tom Wheelwright. It's called Tax-Free Wealth. Tom Wheelwright is the CPA for Robert Kiyosaki, Rich Dad Poor Dad, and Tom Wheelwright wrote a book called Tax-Free Wealth, where he talks about these strategies that utilize depreciation to make sure that you're paying very little in taxes. And so, one of my favorite books, it's a great book if you're investing in real estate, gives a lot of great pointers on how to pay very little in tax.
Okay. What are your main source of information to learn and grow?
My main source, as I mentioned before, kind of one of my roles here at our company is I go around the country and present at different conferences. And I can't begin to tell you how much I've learned from others at these conferences, whether it's other attendees or attending somebody else's session. You've got to invest in yourself. You've got to be as knowledgeable as you can be when it comes to both taxes, analyzing a deal, 1031 exchanges, Delaware statutory trust. There's all these different things that you've got to have you don't have to be an expert in all these, but you got to know a little bit about it if you're going to start building your investment portfolio. And so I think that don't shy away. These conferences, they cost money. Yes, you got to pay to go to them. You may have to travel out of the state, but that's something that nobody can ever take away from you is your education. And so I found more than, reading publications or listening to different presentations online. I found that attending these conferences live, networking with people, I learn better in a live environment. But don't be afraid to invest in yourself and pay for education because it's super important, especially if you're investing in real estate.
No, absolutely. I always say network is your net worth. So
That's right.
always keep networking, and conferences are the best place to, meet new
Yep.
people, network, and, uh, build some knowledge. What is the best business or investment advice you'd like to give to our listeners?
I'll kind of go back to what I started with that first rental property I had where I thought I would be able to manage it. I had to learn the hard way. It's taken me, my wife will tell you I'm stubborn. I probably am a little bit stubborn. But so I usually learn lessons the hard way. But what I've learned the hard way, unfortunately, is that you got to know what it is you're good at and then outsource everything else. So I'm not a great marketer. I'm not very creative. And so if I'm trying to market my new investment opportunity, I probably shouldn't be putting together the collateral to be able to do that. I need to outsource that. So my advice would be stay in your lane, identify what it is that you're good at, what your passions are, and then make sure you outsource and get a team of people around you because you can't be, there's a saying, the expert in, I'm going to butcher this saying. You can't be an expert in anything. If you're an expert in everything, then you're average at everything. I can't remember the
Yeah.
saying. You maybe have heard it, but
I heard about it. It's what is it called? I can,
I
it's
can't
right
remember.
here. I can remember it.
I know. I know there's a very famous saying that the
Jack
expert in
of all,
everything.
master of none, something
Yes,
like
wait, say
that.
that
Yeah.
again. Say that again.
Jack of all, master of none.
Yes, that's what it is. Yes, exactly. So we just don't have the bandwidth to be able to master everything. So find
Yeah.
it is what it is you're passionate about, master that craft, and then make sure you surround yourself with a team of people who can fill in the rest.
Yep. All right. Final question. How can Decoding Cash Flow listeners get in touch with you?
Yeah, so the best way is through our website. It's just www.costsegauthority.com. My contact information is on that website, my cell phone number, my email. Please use this as a resource. Like I said, if you guys have properties that you think might be good candidates, you can go to that website, click on a button, request a free quote. We'll give you an idea of what the expected tax savings would be, as well as what our fee would be, and then you can decide if it makes sense from there. But again, please use this as a resource, guys. We'd love to hear from you.
Yep, we'll surely put all these details in the podcast page once it goes live, so listeners can review and get in touch with you as needed.
Okay.
Erik, thanks a lot for coming on the show. It's a pleasure talking to you.
All right. Thank you as well. Thanks for having me.
Thank you.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.